Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And I have a fun one planned for today. We're actually going to be coining a new options trading phrase, and we're going to be exploring how options traders sometimes use options in an effort to replace the cost of stock ownership. We're going to be talking about a strategy known as a synthetic stock. Talk about how it can act very much like stock ownership and how it actually falls short to some extent. And then finally, I want to introduce something that I'm calling the Pinocchio effect. Let's see if it makes sense to you. We'll explore that right at the end, but a lot to cover. Before we can get to any of that, though, let me first of all say hello to everybody chatting in. Great to see all the familiar names. Great to see anybody who might be here for the very first time, but hello there, Jay Richardson and Lawrence, Tony, Mark, Olga. Who else is here? Got to scroll up a little bit. There's Eva, of course. We also have Sam and Greg and Charles and everybody else. Thanks for joining us week after week. We do appreciate your attendance and your contributions to these discussions. If you happen to be here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts. But you're certainly invited to join us here in our live stream audience. This is a Tuesday webcast series, and we kick things off promptly at noon Eastern time. I also want to let you know that my very good friend Mike Fairborn is joining the live stream audience in the chat. He's going to be keeping an eye on any questions that might arise just during the flow of the presentation. If I can't get to those, Mike's there to pick up my slack for me. Mike and I have worked together now for nearly 20 years. We all know Mike. We know he brings a ton of experience to this discussion. Thanks for having my back there, Mike. Mike and I would also like to issue an invitation to everybody listening to follow your favorite Schwab presenters on social media. You can find us on X. You can find us on LinkedIn. You can find Mike there on X at Mike Fairborn CS. You can find me on X at Cameron May CS, and you can find me on LinkedIn. Just go to linkedin.com/n/Cameron May CS. But let's get into this discussion of synthetic stocks. And what in the world is this guy talking about with something called the Pinocchio effect? Well, before we have that discussion, we first of all have to bear in mind that risk is real. Yes, options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for today's discussion. And today we're talking about something known as synthetic stocks, which was where an options trader uses a combination of option strategies to create something that looks and behaves an awful lot like stock ownership, but potentially at a dramatically reduced cost. And that can be attractive. It can carry some risks as well. But it also, a synthetic stock can come a little bit short of stock ownership. So we want to explore what a synthetic stock is, how it behaves like a stock, how it doesn't behave like a stock. We're going to be planning and placing an example synthetic stock trade. And then we're going to explore this thing that I'm calling the Pinocchio effect. All right. But let's get right to the Thinkorswim platform and start to build and understand a synthetic stock position. Charles says, interesting strategy. Great. Let's get into it. Here's the S&P 500, and we're having a little bit of a rough day, down about 1% today, but you'll notice we've pulled back down to what could be, to some chart users, apparently an important trend line. For looking back over the last 12 months, rising right along just like a ramp, it seemed that prices were just bumping along using this trend line as a price floor. And then we broke down through that on a really strong drop back in March and April that we all remember, and we've recovered it up from that. And it appears that we've once again established a trend line, a potential price floor around that line. So let's just say that our trader here, this is our hypothetical trader, is looking at the history of the S&P 500 and they think, well, despite today's sell-off, maybe this is an entry opportunity for a bullish strategy. Maybe I ought to be out there buying a stock. Now, does that guarantee that the stock market is going up from here? We don't know that. But let's just say that it's our trader's conviction that this looks like we're at or near a pretty strong price floor. and they think that prices might rise from here. Now, I don't want to draw a horizontal line. Let's switch up our drawing tool. Let's switch this to our trend line tool, just so that we can envision maybe what's going on in this trader or investor's head. So they think maybe stocks are likely to go up. So they have the idea to maybe buy a stock. And today's example stock that we're going to be using is going to be NVIDIA. It's just one that we don't already have any position in our example portfolio. It's the biggest company in the world right now. But what we'll notice about NVIDIA is that much like the S&P 500, it's been coming down, actually down quite a bit more, but maybe encountering a potential price floor. So let's say that our trader looks at this. It looks like we have a range of potential support between maybe around 194, 195, up to about 200 bucks. And we pulled back down to that low, and we just touched at that low and starting to gain a little bit momentum. Another rough day though for NVIDIA. So yeah, this is buying as prices have gone down. The hope here for our trader is that maybe prices will go up, and maybe what they're looking for is possibly for prices to rise back up to where they've been a couple of times in recent history. All right, well, if they have that outlook, maybe they buy the stock. It's a $202 stock. Maybe they buy the stock and see if they can later sell it for $230. Now, there's also the possibility that we just keep going down. Maybe our trader thinks, you know what, if we sneak down below that apparent price floor, maybe their plan is to take their lumps if they slip down below 194. So we have the idea in place. Now let's go start to put it into practice. So as we go to place a trade for NVIDIA, maybe our trader would like to take ownership of 100 shares of stock. Well, 100 shares of NVIDIA is about $20,000, $20,239 at this moment, changing by the moment. So that cost associated with buying 100 shares of stock can be prohibitive to some portfolios, or maybe the trader's just not that convinced that price is going to go higher. Maybe they don't want to commit that much of their portfolio to that stock trade. So what if there were a way that we could create a very similar trade at a lower price point using options? And this is how we're going to we're going to introduce our example strategy for the day. Let's make this nice and bold. But our example strategy is going to be something known as a synthetic stock. What in the world is a synthetic stock? Now, how many people do we have watching? 120 people watching right now. I would suspect that there's a good number that are familiar with what a synthetic stock is. So just give me a quick Y for yes and N for no. Yes, I'm familiar with the strategy. No, I'm not. But this webcast series is called Getting Started with Options. So I'm going to go to a pace that hopefully everybody can follow to construct this synthetic stock strategy. We're going to talk about the pros, we'll talk about how it's built, the pros of the strategy, the cons of the strategy, the potential for reward, the potential for risk, all of that stuff. Okay, so I'm getting Alejandra, no. Adam, no. Olga says yes. Lakshmi says yes. Barbara says no. That's what I suspected. Pretty good split. Seems like more no's are coming in than yeses. So yeah, let's make sure that we cover this very deliberately. So here's how a synthetic stock works. And if we do it right, it does actually behave, even though we have options and we think about all the intricacies of options. How can they really behave like a stock? Well, here's how it works. Let's go out in time. Looking at our chart, maybe we think the stock is likely to go up over the next month or so. Let's make sure that we give ourselves enough time in this trade. So how about we go out here to the trade tab. Let's go out past July, that's only 24 days. Let's go out past August, that's 59 days. I'm going to go to September. Give the trade 3 months. Ted says that'll generate a temporary credit. Depends on the one that's selected, Ted. Yep. But let's open up the 18th of September contracts. We're going to be doing a trade that's going to allow us to be in this synthetic position for up to 87 days. And what I'll do with the stock trading right around 202.5, we might be splitting some fine hairs here. We could go right to 200 bucks. Let's go to 205. Ted, this is going to do that for you. This will probably generate a credit for us. But here's what we're doing. Instead of buying the stock, what we're first going to do is buy the right to buy the stock. So we're going to buy the 18th of September, with the stock trading around 20, it's actually, look, it's closer to 205 than it is to 200 at the moment. It's right there in the middle. But we're going to buy the 18th of September 205 call, and that looks like that's trading between 1590 and 1605. I'm going to use a nice round number. Let's say we have to pay 16 bucks for that. All right. Now, for some, they may actually see buying a call as a form of synthetic stock. Well, we're not buying the stock, but we're getting into a contract that gives us the right to buy the stock. Isn't that the same thing? Sort of, but not really. It actually doesn't do a very good job of behaving like the stock. Let me explore this. So if we were to just spend the 16 bucks per share, that'd be a $1,600 trade. That's a whole lot less than 20 grand, but it doesn't behave exactly like the stock. And that is for a couple of reasons. And there's actually an additional, well, there's a related reason here where a trader might not be attracted to this as their trade scenario. But if we're familiar with options, we know that unlike a stock, with a stock, when we buy the stock, we pretty much just have to watch price. If price goes up, great. If price goes down, not so good. Yes, there are other things like dividends and so on, but potential stock splits, that kind of thing. But on a day-to-day basis, we're mostly interested in what happens with the stock price. But with options, we have price movement, we have time decay, and we have even changes in volatility. Expectations for how volatile the stock is going to be in the future can actually impact the pricing of our option right now. So we got this series of balls that we're juggling, trying to keep an eye on how our option is changing in price. And I just want to look at one in particular. I want to look at just the price of the stock moving up and down. If we buy this call here, and then the stock goes up $1, well, shareholders just made $1. And we want to be something similar to a shareholder. But if we just own the call, someone out there who's a little bit more veteran with traders, tell me, if this stock goes up $1, how much do we theoretically make on our call investment? Only 54 cents. That's what our delta tells us. Delta can tell us a couple of things. It can tell us the relative probability that our contract might be in the money at expiration. So that we might say there's a 54% chance that our call is in the money at expiration. Another thing that it can do is tell us how much we might make or lose as the stock goes up or down $1. Delta starts with D, so does dollar. So this would tell us that if NVIDIA were to pop up $1 today, an unrealized gain of about 54 cents might be made. So that's only 54% equivalent to stock ownership. The stock owners are getting the full benefit. We're getting fractional benefit, not behaving like the stock. Also, we're exposed to time decay, and we're exposed to volatility changes. Wouldn't it be nice if there was something else that we could do that could make this behave more like a stock, get dollar for dollar potential return, yes, taking on dollar for dollar potential risk as well, but kind of move the time and the volatility discussion out of the equation so we can just focus on price? Yep, that's one thing that a synthetic stock trader might be pursuing as they finish building this strategy. Now, another thing that the trader might not be thrilled with is actually all the leverage that comes with this call purchase. If we spend just the 16 bucks to buy the call and the stock does go up $1, well, we may not make dollar for dollar return, but we do make 54 cents. 54-cent return on a $16 investment is it's about 3%. 3% return on a $1 move on a $200 stock. So the stock went up 0.5%, that $1, and our call goes up 3% in value. Or if the stock drops 0.5%, our call loses about 3%. That's a significant amount of leverage. So let's turn this into a synthetic stock position. And I know a lot of this can sound a little bit complicated, but really all we're going to do is buy a call and we're going to sell a put at the same time. That's it. We're not even going to change expirations. We're not even going to change stocks. We're not going to change strike prices. We're just going to stay right here with the same expiration, 18th of September, the same strike price, but we're going to sell a put. And that looks like that's trading right now for between 1620 and 1635. Let's say we're able to get, let's do 1630, just again to use round numbers. Might be able to nickel or dime it here a little bit better, little more, a little less. But let's just say that we collect 1630 on this put. So what are we doing here? Here's how this transitions this into a synthetic stock position instead of sort of just behaving not entirely like a stock. What we're doing is we're buying a call, which is bullish, but we're pairing that with selling a put, which is also bullish. So we're doing a combination of two bullish strategies. But because we're buying one and selling the other, we're removing the impact of time decay and volatility to almost full extent. Because time decay, for example, typically hurts buyers. Well, who does it help? It helps sellers. Guess what? We're one of each. Time decay can hurt our call, but help our put at the same time, same 24-hour period. A volatility shift typically helps buyers, but it hurts sellers, or vice versa. So that can become a wash. So if you haven't seen this before, let's spell this out in real numbers and see how this really can behave very much like stock ownership. And that, what I talk about with the numbers, are the Greeks. Okay, Charles says, how are you managing the risk if the trade doesn't go to plan? We're going to do that, Charles. Yep. But let's look at delta in a little bit more detail. We're also going to look at theta and vega. All right. So let's start with delta. We own a call. And by the way, one underlying thing that we need to be aware of is that our Greeks are always assuming that we're a buyer. So you notice some of our Greeks are positive, some are negative. Those are the potential impacts on the trade for an options buyer. When we're selling, we need to reverse those numbers. So if one's positive, that's positive for a buyer, it's negative for a seller, and so on. So we'll see that here in just a moment. But let's say we buy this 205 call, the stock goes up $1. How much does that call make? Well, we know that holding our other variables constant, we might make 54 cents. Not getting the full return, that dollar for dollar return of stock ownership. But now we've paired this call with a put that we've sold. So let's go over to the put side of the equation. Look at our delta, and it says negative. Well, yeah, that's assuming you're buying a put. If the stock goes up, put loses value, negative 47 cents. We're selling the put. If the put goes up and we sold it, that's a positive impact of plus 47 cents. Do the math for me. 54 cents plus 47 cents equals $1.01, according to my math. Doesn't that look a whole lot like $1? The stock goes up $1, and our combined strategy here makes $1. If the stock goes down $1, our combined strategy here loses $1. Now there is a penny that I'm kind of leaving out of the equation. That's because these two-digit numbers probably have a little bit of rounding bias in them. We don't display delta out to multiple digits. Just leave it at 2. So it might actually be 0.535 or 0.465, something like that. So it's rounded. So it's probably even closer to $1 than we're seeing here. But that is now behaving, thanks to the combination of two bullish strategies, like the stock. Stock goes up, we make $1. Stock goes down, we lose $1. But we think, well, what about time decay? I only have 87 days to get this trade done. Isn't time working against this trade? Well, there is a prescribed time frame, but what's the net impact of theta? If we bought that 205 call and one day goes by, ouch, we lose 10 cents due to the time decay. However, we also sold a put, and that put, we need to reverse this. It says negative. That's because it's assuming we bought the put. This actually becomes a positive 8 cents. Time decay helps the seller. So what's the actual impact of time? We actually might be exposed to losing about 2 cents. Let's throw in the extra, let's throw in the 0 before this so that we're grammatically consistent here. Yeah, time decay, it's there to some extent, but not very much at all. It becomes very much a secondary part of this equation. And who's driving this vehicle now? The stock movement is. Well, what about volatility? Volatility levels rise and they drop and they rise and they drop. And as they go, so do typically the pricing of options. And if we needed to exit, that could affect our ability to exit, profitable or unprofitable. Well, let's look at volatility. So if we buy this call and volatility levels rise, well, that helps us 39 cents. I'm going to leave the zero out of that. Sorry. All right. But if we sell the put at the same time, wait a minute, that's also 39. We need to reverse it because we're selling. It's a minus 39. So what just happened to Vega's role in this equation? How much do we need to sit there and scrutinize what's happening with expectations of future volatility? We probably don't care. With this trade, Sam says this trade has to go up, simple as that. That's pretty much the case with non-dividend paying stocks too, isn't it? Yeah. They need to go up for us to make money, need to go down, or if they go down, we lose money. Well, that's exactly what this is doing. So why would a trader do it? Well, because they think the stock is going to go up. Is there risk the stock could go down? Of course there is. That's always present in stock trading. So, but what has been accomplished aside from just creating a position that mimics a stock? Well, this can be done at a much lower price point, and that's attractive to some investors. They create a scenario where for a period of time, we did it for 87 days, we could have gone out just as far as we want and constructed a trade that probably doesn't cost anything or very similar price, maybe a small net credit, a small net debit. That really is inconsequential. Getting a credit up front or a debit or paying a debit up front doesn't matter so much as what the stock does afterward. Because if the stock goes up, we make it $1-ish. If the stock goes down, we lose $1-ish. But here's where the real attraction for the strategy for some traders is revealed. Let's put this together and start to put it in an order here. I'm going to go to spread single, and I'm going to change this to a synthetic. Do you see that word right there? Synthetic. And what this does is it just pairs up the call with the put. So instead of seeing the individual strike prices, what this is prepared now to do is to create this synthetic order. So if we were to click on the bid price or the ask price over here, it would buy or sell. Well, let's just stick with the bid price. I'm going to come over here and click on the ask price at the 205 call, the 205 strike pairing. So as I click on that, you'll notice this brings up an order to buy. For me, it's going to be one call. I've set my settings up here, my order settings. So if you haven't done this, if you didn't know you can do this, you can set your general settings for how many contracts or how many shares are purchased right up here. You can go to the application settings for the entire platform and change your order defaults. And what I've done with my options is I changed that to one contract by default instead of 10. And then I just applied that. So that's why this is coming up as 1. Just be aware, the actual default is 10 contracts, which would be a synthetic version of 1,000 shares of stock, right? But we're going to buy one call for the 18th of September, that 205 call. We're going to sell one put for the 18th of September. It looks like our credit has grown a little bit. When I mapped this out, it looked like we might be getting maybe net a 30-cent credit. It looks like it's moved more towards 60 cents. That's probably because the put has gained a little additional value. The stock price has probably come down a little bit. The call has probably lost a little bit of value. Anyway, Charles says, I remember seeing similar trade with MU in May, didn't understand it. So that's it. Just be aware. We're buying call, selling a put, 2 bullish trades combined is creating this synthetic stock position. And it may be for a small credit. It may be for a small debit when we're trading at the money. That's typically the scenario. But again, the trader doesn't really care necessarily whether it's a credit or a debit because that doesn't represent gain or loss to the portfolio. What does is what happens after the trade is taken, right? But let's do a comparison here. Just one contract, one pairing of contracts creates a synthetic version of the ownership of 100 shares of stock. 100 shares of stock would cost the trader $20,200 and change. Let's click confirm and send here. And how much is this costing us? Well, you'll notice there's this field right here. So we're going to buy this. It's calling it a combo. This is more accurately described as a synthetic stock position. But buying the 18th of September 205 call, selling the 18th of September 205 put. But how much is that going to tie up in this margin account? About $5,600, not $22,000. So if we're investing roughly a quarter, usually works out to about 25% of the cost of stock ownership. So there is certainly still leverage here. If we're getting the same amount of upside potential as stock ownership, but at 1/4 of the cost, that means that we're getting leverage of 4 times. Does that make sense? If we only spent $5,000 and the stock goes up $1 and we make $100, whereas someone else spent $20,000 and the stock goes up $1 and they make $100, we're getting 4 times the potential reward. We also have 4 times the potential risk if the stock can go down. Now, what we might have done, could we have just bought the stock on margin? Yeah, that would tie up about $10,000. If you're just familiar with margining stock, I'm not saying I'm not going to go deeply into that, but it's basically borrowing in order to buy stock. And typically we have to put up 50%, and then the borrowed amount is 50%. So the leverage is 2. With this, our leverage is a factor of 4, generally, right around there. And I had somebody ask me once, well, where does that come from? Why is it that much? Well, it's the cost of the call. We have to buy the call, and then we have to cover the risk of the put. Typically, when we short a put, there's about a 20% margin requirement on that. So typically, it's about 20% of the strike price value, if you want to run the numbers on that. But 20% on a $205 strike is going to be around $4,000, plus the price of the call that we're buying. That brings us around here. Anyway, bottom line, though, is we have successfully constructed a trade that is going to behave very much like stock ownership, except it only costed a quarter as much, for good or for bad. Now, one other thing that's introduced here is there's a little bit of a commission to be paid. No commission on stock trade. There is $1.30 to be paid on this option trade. Now, I'm not going to actually send this off. Not just yet. Because here was the original plan. If our stock goes up, we're looking for taking profits at 230. If our stock goes down, maybe we have a stop down below 194. But I do want to talk about how I've kind of given this a lot of credit for being like stock ownership. Yep, it behaves just like stock. Buying the call, selling the put behaves in price movement almost identically to the stock. It doesn't have much time decay, if any. It doesn't have much volatility exposure, if any. The real focus is the stock going up or down? How does it differ substantially, significantly from stock ownership? Well, even though we have a contract that gives us the right to buy the stock, we don't actually own the stock. So if a dividend is paid, we don't get it. That's number one. No stock ownership, no dividend. Also, no stock ownership, no voting rights. And finally, there is a time frame attached to this. This trade is good for 87 days, although I want to come back to that thought. Definitely want to come back to that thought. But how about we put in our trade here, and we're going to enter into this synthetic stock, and if the stock goes from around 202 up to 230, we're going to sell and take our profits. How much profit might we have at that point? That would be about a $28 gain. And if we're mimicking the ownership of 100 shares, that would be $2,800 on a $5,600 investment. That'd be a 50% gain on about, it's a little bit more than 10% increase in stock price. What if the stock falls? Well, if stock falls, let's just have an exit down here below 194. So that would be about $8 of theoretical exposure to risk. Now, this is not a guarantee that we'll get out with exactly $8 of risk. If the stock, let's say, gaps down, we could take a bigger loss. But about a $28 upside potential, about an $8 risk to the downside. And we're really mimicking that performance of, or that stock ownership. But here's how we entered that trade. Maybe we'll just start. Well, you saw how we did this, but let's do it one more time so you can get some repetition here. So we start with a spread set to single. Let's just switch that to synthetic. And we go down to the strike pair that we're interested in, and we click on the ask price. It actually doesn't matter whether we click on the call ask price or the put ask price. You'll notice they're both the same, but we just want to buy this synthetic stock. Now, let's say we want to take profits if we can get to 230. So we need to put in a sell order to take us out there, or take losses if we fall down below 194. We need to put in a sell order down there. So we're not just going to put in one single order. Let's put in a first triggers OCO order. I was reading a question here. Ted says, everything else being equal, would an expected dividend be priced into call premiums? Yes, dividends are priced into, they do impact options, Ted. The answer is yes. Anything that can affect price movement is priced into the options as well. Yep. Anyway, but let's finish our order here. Once I've selected this order type, first triggers OCO, that means if our first order fills, it's going to trigger a second or two other orders to go into effect, one to take profits and the other one to take losses. Whichever one fills, it's going to cancel the other. One cancels the other, OCO. So I'm going to right click on the original order and create one opposite order. That one's going to be our profit order. Then I'm going to right click again and create another opposite order. This one's going to be take our losses. All right, so let's, looks like our credit is shifting. Price is probably drifting down a little bit again, or creating a little bit more value for the put, a little bit less cost for the call, increasing that credit. But here's what we're going to do. Let's put in a condition. If price rises to 230, sell this synthetic. If price falls to 194, sell this synthetic. And those conditions can be entered over here to the far right. You'll notice as I point at this little square, I get a little gear icon. That's the conditions icon. If I click on that, I get this big pop-up menu. So this is what we're going to do. Sell this combo or this synthetic if, let's set our price rules to market, and I'm going to set that to good till canceled. But we're going to do a market order if NVIDIA, that market price, rises to greater than or equal to 230. There we go. So if you're not familiar with this conditions page, you're just saying, hey, here's my condition. If the stock market value becomes greater than or equal to a certain price, do this. So here's what that means. Sell this synthetic at that market price, whatever it is. Most likely it's going to be about $28 more than we paid for it or received as a credit. And we're going to save that order. And then we're going to change the other one. Let's click on this and add a condition. We're going to sell at a future market value for that synthetic. But that's if NVIDIA market value falls to less than or equal to 194. Let's click save. So there's our full trade. Looks like our credit has been bouncing around. Let's say that we're willing right now to accept a credit of, let's just say 80 cents. There we go. And we'll click confirm and send. So we're buying this synthetic, that 18th of September 205 call put combo. In this case, generating a little credit, whether it's a credit or debit, really inconsequential to the trade. It's what happens afterward. So if the stock goes up to 230, we're going to sell it. If the stock falls down to 194, this effectively is our stop. Again, we're not guaranteed that we will sell at 194. If there's a gap down, we might sell below that, take a larger loss. And we're going to send that order off. So there are commissions to get in. There will be commissions to get out if we get out either at our target or our stop. So there we go. So that trade is in place. But there we go. We're in. Got a 95-cent credit, actually. Said we were willing to settle for 80 cents. We got 95 cents. That's nice. That doesn't mean anything about profitability or loss. That comes from price movement. Now, I wanted to talk about something here, though. We think that we've covered all of our bases. If the stock goes up, great. We sell and take our profits. If the stock goes down, great, well, not so great, but we take our lumps and we're done, right? Well, what if the stock doesn't ever reach either of those? What if we don't go up to 230, we don't go down to 194, so neither of our exits are triggered, and over the next 87 days, we hit expiration. I want to talk about expiration because it's a big spooky thing for a lot of options traders. You wonder with any strategy, what happens to me if I'm in this thing and I forget about my trade and it goes to expiration? And this is where I say we have what I call, this is our new phrase. I don't think I've ever heard anybody refer to it as this before. I call this the Pinocchio effect. That's where our synthetic stock position, if you don't know what synthetic means, it means sort of fake. It means imitation. If you have the synthetic leather jacket, you don't actually own a leather jacket. You have a fake leather jacket. Well, at expiration, our synthetic stock, through the magic of the Disney Imagineers in the studios, no, it's actually just because this way options work, it transforms from a synthetic stock position to a real stock position, from a fake boy to a real boy, I guess. That's why I'm calling it the Pinocchio effect. Why does that occur? Well, we have a call and a put at 205. If the stock is above 205, the call at expiration gets assigned, gets exercised in our case, and we buy the shares for 205. The put just expires worthless. If the stock is below 205, well, the call expires worthless, but the put is assigned and we buy the shares at 205. So whether we're above 205 or below 205, one of those contracts results in us owning the shares of stock, and where before we were just mimicking stock ownership, well, we now have stock ownership for better or for worse. So that is what happens at expiration with this strategy. Our synthetic position becomes a real position. Now, what we have to be prepared for then is the cost. Because we did all of this to try to maybe avoid that cost. If we buy the stock on margin, we got to pony up half. In a real account or in a cash account like an IRA, got to pay the whole event. So Charles says, Cam, so the end game is to own the shares, worst case. Yeah, ownership, it can be painful, especially if we're paying 205 for a stock that has really dropped hard in value. Yep. Yeah. But yeah, that is what happens at expiration. In almost every scenario, it's hard to think of a scenario where that wouldn't happen. Because we're above 205, the call gets exercised. If we're below 205, the put gets assigned. Both of those work out to share ownership. So can you forgive me for giving it that? Does it sound like the Pinocchio effect? All right. But guys, with that, we've actually accomplished what I set out to do today. I wanted to weigh the pros and the cons of the strategy known as a synthetic stock. It actually does behave very similarly to stock ownership for the time frame of the contract at a lower price point. Now that introduces leverage, and leverage can make profits. It can accelerate profits or it can accelerate losses. And if we let this thing go all the way to expiration, then we encounter what's now known as the Pinocchio effect. Fake trade becomes a real trade. Charles, I stimulated your brain today. Well, that's good. I think that anytime we're talking about multiple legs on a strategy, it might take some time to absorb what's happening here. So I would suggest go back and watch the archive for this one if you need it. So if you're not familiar with this, if you're new to our channel, make sure that you're subscribed to the channel. It's called Trader Talks Schwab Coaching Webcasts. You can subscribe to our YouTube channel just right down below the video stream. Just click on the subscribe button. It doesn't cost anything to do that. But this is where we host our live streams, just like the one that you're watching right now. You can also find our playlists of previous webcasts right here. So if I were to click on this playlist link, my series is actually all the way down at the bottom for getting started with options. It's right there. So you can click on view full playlist and see all of the previous webcasts in this series. Now, another thing that Mike and I would suggest you do is to follow your favorite Schwab presenters on social media. You can find us on X. You can find us on LinkedIn. You can find Mike on X at Mike Fairborn CS. You can find me on X at Cameron May CS. So here's my handle on X. And if you reply to one of my posts, I just try to reply right back to you. I had this little observation about Elon Musk's net worth. Some estimates coming in between $1.1 and $1.2 trillion, which I noticed that's right about the same amount as the total credit card debt that all Americans are in combined right now. That's a wild statistic, isn't it? Anyway, so if you reply to those posts, I just try to reply right back to you. I also post on LinkedIn. So you can just go to linkedin.com/in and add /Cameron May CS, and that'll take you right to my profile. You can give me a follow there. And if you reply to my posts here as well, I just try to reply right back to you. All right. But guys, thanks for giving me your time today. It's always very much appreciated. We have a lot left on the slate, lots of webcasts coming up. Go enjoy those. But thank you to everybody that's already clicked the thumbs up out there in YouTube land. I can see still 135 people watching. And how many have clicked the thumbs up? 49 people have already clicked thumbs up. That's really appreciated. It's a nice pat on the back to your presenter. But it also gives my video a little boost in the YouTube algorithm. Every time somebody clicks the thumbs up, it tells YouTube, hey, people are enjoying this. Maybe we ought to show it to more people. Let's more people find these discussions. Anyway, thanks for giving me your time. I'll look for you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I wish you the very best of luck. Happy trading. Bye-bye.